South Africa's biggest insurance companies are expecting a wave of cash-strapped South Africans to withdraw up to 25,000 Rand each from their pension savings when the new two-part retirement system comes into effect next year. This comes after the National Treasury and the South Africa Revenue Service published draft legislation for the new two-part retirement system, which is set to take effect from the 1st of March 2024. Trade unions, SA Federation of Trade Unions, SAFTU, and COSATU have welcomed the legislation, saying it will provide much-needed relief to many workers who are already battling to make ends meet. The reform is meant to deter South Africans from cashing out their retirement savings when they resign, and also aimed at preventing workers from resigning to access their retirement funds. The changes are being introduced in response to consumers' dire financial stress during the COVID pandemic, when many were unable to access their retirement savings despite having no other money to turn to. Joining me now is Trevor, Shaku, spokesperson for the South African Federation of Trade Unions. Trevor, welcome again to Business Edge. Thank you so much for joining me.
And thanks for having us.
So, Trevor, let's start with you just briefly taking us through the changes that are going to come into effect from March 1st, 2024, when it comes to this two-part retirement system. What are we expecting?
So, with the amendments, we know that at least two processes are going to follow. The first one is the capital seed, which would allow workers to withdraw once of 10% from their retirement, up to 25,000 rands, which they will be able, of course, to use for various reasons, for various other factors, or for various other things which they need to spend on. The second one is that they are allowed to access 1/3 of their pensions throughout the lifespan of their career until they retire. And only after retirement, they'll be able to access the other 66.66% of the retirement pension. So this, in our view, is very progressive because the South African workforce is highly indebted. If you look at the reports which are released by DebtSafe, which usually monitors the amount of debt that workers accumulate in comparison to the interest rates which accumulate in this country, especially have accumulated over the past 11 months in this country, it shows that South Africans, the average South African worker actually spends 65 to 70% of their income on servicing debt and credit. And on top of that, they spend 80% of their income within 5 days of receiving that particular income. Wow. This shows you the level of precarity of the South African workers. And as a result, we think that this is going to be a necessary reform which will allow workers to access money so that they can buy property like houses, because most of them are rentiers, especially in the urban parts of the country, are rentiers. Those who are not rentiers and have attempted to buy their houses are actually struggling to maintain those particular houses. They have to choose either to buy a vehicle or a property.
Okay, so that gets us into the retirement, the savings, and of course the vested parts, which are aspects of this retirement system. But part of the reforms or the pressure for the reforms for this pension system also came about because of the situation caused during the COVID-19 pandemic. Trevor, take us through that. What exactly happened to workers during the pandemic?
So a number of hardships, including the fact that workers lost their jobs. But how do workers in the other part of the economy losing their jobs affect others in the other parts of the economy? What has been published in the past 2 weeks, the special economic reports which have been published, shows that the average worker would be supporting about 5 to even 15 members of a household or an extended family. And in this context, it meant that these particular dependencies, which have increased, have had pressures on the incomes of those workers who are working in those particular families. So this is the first element of the impact of COVID-19 unemployment, mass unemployment in the country on those who continue to retain their jobs. Because if you recall, unemployment rose,
Yes.
Unemployment rose by 2 million during COVID-19. Now, in addition to this, what has happened is that since November 2021, the South African Reserve Bank then started hiking interest rates because it said it needed to normalize the policy rates in accordance with other central banks across the world who were beginning to do so. And as a result, they started first with a 25 basis point and cumulatively every second month increased interest rates until last May. And we also are thinking that they may increase them even coming July. Now, this on its own had another impact, an impact which I've already explained, which made the cost on financial liabilities to rise, but also just the basic costs, the basic loans such as home loans, car loans, which workers already had to begin to become expensive. And as a result, ate on the very income. Now you had the rising cost of living eating on the incomes of workers, the interest rates eating on the incomes of workers, and the unemployment, which rose highly in 2020, 2021, also eating on the incomes of those workers. And as a result, there was a diminishing standard of living for the South African worker as a result of COVID-19 and the aftermath of it.
And then there was this money that was in the retirement system that they could not access when they were facing these dire situations. So, Trevor, there are some concerns that the legislation does present a danger of people not saving enough towards retirement or even cashing out too often, leading to issues further down the line. So there is some research that shows that only about 6% of South Africans will one day be able to retire comfortably, while the rest will depend on their children, the state, or even other possible sources of income in the long run. So the option to withdraw retirement money when push comes to shove could also have, yes, immediate relief in the much needed short term, but the concerns about the long term, particularly savings habits or savings sort of situation, come up. Do you think that these concerns are valid? Are there any safeguards within the two-pot system that can prevent something like this?
No, for us, they are not valid. The two-pot system, first of all, is not saying workers must withdraw the whole thing. That's why they call it two-pot. And as I've explained earlier, the 33.33% of the retirement fund would be accessed by workers during the span of the career, which means workers would still be left with 66.66% at the end of their career by the time they reach retirement. And it is not even wrong in the case that workers might have used that money, that they begin to depend on the state. The state is there. Under capitalism, the employees are made to depend on the state because employers refuse to take social reproductive costs of reproducing those particular workers, including beyond work. Now, in this instance, even if the South African worker was to use the retirement, all of it on, for instance, buying property for their family, such as car, and most importantly, a house for their for their families, that would still be a good contribution for the livelihoods of these particular workers, because the conditions in which the South African workers are living in the informal settlements, in shacks, is actually unacceptable. And these workers must utilize whatever little they can access to buy houses for their own families. Now, in the context of the post-career, which would be the pension phase of that particular worker, if they have little remaining of their pensions, we know, as a matter of fact, the state has pension grants for those who cannot be able to generate income. So there is some form of cushion that is there from the state, and these workers will be able to survive on. But it is certainly better than having a worker who works, for instance, 65 years, but does not have a house. So these people have to withdraw that money and buy themselves houses in the context where the state is refusing to build public houses for these workers.
Okay, So your organization, SAF2, has been advocating for such a system for a while now, but you've also raised concerns about people lending excessive amounts to stay afloat each month. And as you've mentioned earlier, about how much of South African workers' income goes to paying off debt and how quickly each salary every month is gone. Within 5 days, you said about 80% of the salary is already spent. So when it comes to conversations around people using these pensions to possibly pay off loan sharks or to pay off excessive debts, what do you think the conversation needs to be? How can governments and even companies even ensure that workers are not falling into the cycle of using this money when they have access to it for paying off loan sharks or paying off further debts? How do we get into that? How do we solve that issue?
In fact, it's a solution to that issue on its own, because the workers end up going to loan sharks because they don't have any cash at their disposal to be able to buy certain necessities, the ones I've mentioned. Because for us, what is important is for them to buy houses in urban areas where they are not able to get housing. And because the state housing, those who are able to access state housing are mostly the lowly income paid workers and those who are not employed. It means that your average worker who's earning an average income is not qualifying to get a state house. So as a result, they have to fend for themselves to ensure that they buy houses for their own families. In those instances, we think that in those instances, then they resort to go to loan sharks or to go to the banks, which in our view are still loan sharks, because they charge huge interest on those particular loans. So in order for these workers to be able to run away from these loan sharks, both commercial and those who are not commercial, the workers must access this particular funding so that they will be able to run from it. It is not that they are going to access it so that they go to loan sharks, but they are going to access this retirement fund so that they can be able to avoid going into debt traps with loan sharks and commercial lending, which the commercial banks are offering. So in our view, it would be a means to an end rather than just a means which would be an end to a means. And in that context, it is the argument of the South African Federation of Trade Unions that the access to these pension funds is going to help a long way in relieving workers of these particular types of debt traps rather than actually driving them into those debt traps.
All right, so the two-pot system is seen by SAF2 as a solution to this loan shark situation. But then there's another trend, one that's said to be particularly seen in governments, where people resign simply because they want to access their retirement funds, and then they go ahead to be rehired, and sometimes they're rehired as contract workers or even go into the private sector. Do you see the two-pot retirement system being able to halt this practice?
Can you repeat that? I couldn't hear.
In terms of people resigning from government in particular to go and access their retirement funds, then getting rehired as contract workers or heading into the private sector, this is also a very big issue for South Africa. Do you think the two-part retirement system will also positively address this?
We think so. Actually, from the onset, when we began demanding that workers must access a portion of their pension fund, we were actually being driven primarily by that particular reason. Especially workers in the public service, your teachers, your nurses, will just retire so that they can be able to access the pension fund. Go and buy a car, go and buy a house, and then try by all means again to try to return to the system or go and look for a job in other parts of the sectors of the economy. So indeed, we think this will be one solution to that particular problem, because that problem was primarily caused by the fact that workers do not have enough to buy houses for their families and to be able to close other essential costs which their households are incurring. So in order to close those particular costs and to be able to afford certain things, they had to retire, get the lump sum, go and pay off these types of costs and also buy certain properties. Now, the access to the retirement fund before retirement age arrives would allow these particular workers to be able to meet these spending obligations which their households have incurred without having to retire. So it would be a solution in our view, rather than a problem.
So let's talk about tax implications or considerations that are associated with the two-pot system. Trevor, how will contributions or withdrawals be taxed? What sort of the criteria to even be able to withdraw or even contribute, but specifically focusing on the withdrawal aspect of this? Take us through some of those details.
So it will be normal taxation that is levied even on on pensions and even on income whenever you retire. When you retire, even at old age, your pension is still subjected to taxation. When you retire, when you resign, even before retirement, and you are able to access your pension, there is still taxation that is levied on that particular pension fund. So for us, the issue around taxation is not necessarily a problem because it is already something that is being levied on those who are cashing on their pension funds. Now, of course, if, for instance, government was to say we're not levying any person who's cashing on their pension, that would be fine, and would, of course, accept it. And if in the future, part of the revisions of this particular law would include revision along the lines of taxation on the pension fund and cashing of the pension fund, would be good for us. We would, of course, advocate for such kinds of reforms. But there's nothing peculiar about taxation in the context of the two pots, because either way, there is taxation that is being levied on those who are trying to cash on their pension at the current moment.
Okay. All right, Trevor, before I let you go, we know how economically challenging things are for South Africans and how the economy itself is struggling. Do you think there are some strategic ways that lawmakers can go about implementing the two-pot retirement system without companies feeling the pressure? And many people are wondering what really is also the role of the employer in the implementation and administration of the two-pot system.
No, the employers are not going to find it hard, especially if they have been implementing the law as they should, because the law is that they should deduct this money and send it to the pension holders. So the companies who are employing our workers are not going to find it problematic if indeed they are doing what they're supposed to do. If they are not deducting the money and sending it to the pension holders, that's where they might find it problematic, but that would be revealing that they've not been conducting themselves lawfully, and there should be legal consequences for such particular actions. Now, the people who might, of course, feel a pinch a little are those pension holders themselves, your insurance companies who have turned themselves into pension holders, such as, for instance, your old Mudra. But we also expect them to pay these workers accordingly, because they are the ones who are taking this money and taking it somewhere. We are expecting them to avail it when these workers are looking for it. The unfortunate part, which of course will reveal certain practices on the part of the pension holders, is that they take this pension money and go and invest it somewhere in speculative assets in the economy. Because we have seen that the people who are involved in the currency market, in the forex market, the people who are involved in the commodity traders market are mostly the hedge funds who take most of the money from the pension holders. So it will also reveal such kinds of practices which these people are using by taking workers' money to go and invest it in speculative assets in the economy, which of course we've always opposed, because we felt that the involvement of the hedge funds, of the pension funds in the speculative activities of the economy had even dire impact on the prices of goods and services in the country. Because what has happened is that the increase in the prices of goods has been influenced by the speculative activities in these particular markets. So we expect each and every one of the pension holders to have the money ready whenever workers want to withdraw it. And we do not expect any problems. Whatever hardships they may be citing, not our problem. It is their problem, because they would have opted to use that money somewhere else rather than to pack the money in interest-bearing safe assets, which government offers them already with government bonds.
All right, Trevor, we'll leave the conversation at that. We know this is draft legislation and it's open to public comment right now before, of course, it's finalized, gazetted, and it becomes actual law starting from March 1st, 2024. Trevor, Shaku, thank you so much for joining me.
Thank you very much.
All right. And South Africa has introduced a new two-part retirement system that's going to allow workers in the country access to their retirement savings, not all of it, but a proportion of it in their career time before they retire. And many of the trade unions, particularly the one that Trevor represents, which is the South African Federation of Trade Unions, say that this is a good thing. It will help to address the indebtedness of workers and also put more money back into the economy. You're watching Business Edge. We're going to go for a quick timeout. When we come back, we have international business news, then a conversation around future-proofing Africa's agri-tech startup sector. You don't want to miss that.